Let's start off on that point. We're seeing the shilling at 80.25 to the US dollar, so basically flat at this point in time. We've seen some purchases of hard currency this week and of course last week. Some say that this isn't a bid for the central bank to try and control the currency, but more so to shore up reserves. Is this your view as well?
Yes, I think I would agree, especially looking at the way they've been coming to the market and buying up euros. I think they've done 10 million in the last 7 days, 5 days actually. And with all the anxiety around the dollar, the euro is looking a bit more stable. So yes, I would agree, they're shoring up their foreign exchange reserves.
Shilling at 80.25 to the US dollar, where do you peg it by the end of the year?
By the end of the year, I actually see it, the CBK may not be, even though CBK comes into the market to buy more dollars, they may not be able to shore up weaken the shilling so much, considering the inflows we're expecting towards the end of the year, it being the festive season. So I'm thinking about levels of 79.
First quarter tax revenue targets were missed by around 22 billion shillings. This is despite the fact that we are starting to see a very strong economic recovery in Kenya. What kind of impact is this going to have on the rates in Kenya?
Actually, this was pretty negative news, which actually means the Treasury has two options: to cut down on expenditure or borrow more heavily from the domestic market. And going by past examples, I would go, they'd probably increase their borrowing from the domestic market, which is already pretty heavy and has been marginally pushing the rates up. So if with 22 billion deficit only in the first quarter of the year, we may see the central bank coming in to borrow more heavily from the market, and in turn pushing up interest rates. For example, looking at the 91-day, which at some point in mid of this year hit a low of about 1.5, is now at levels of about 2.3. So we've been seeing rates moving up both on the short and the long end.
Well, just looking at the second half of the year, perhaps the central bank and of course government can make up the deficit that we saw in the first half, make it up in the second half. I mean, just looking at the cumulative government revenue collection over July-September, that was around 85.7% of the target, so looking slightly better. But then again, last month, the government collected 13.2% higher than a year earlier. So perhaps it'll balance out by the end of the year. Are you optimistic that that could happen?
I'm not too optimistic because with the expenditure expected, especially involving probably the new constitution, and look, there's been a theory that basically the Treasury has been front-loading, but looking at this deficit we've seen in the first quarter, which was unexpected actually, so I'm not quite positive going forward. It might actually balance out.
Do you think it's a matter of the fact that tax collection and tax revenue is going to start being subdued going forward? Because surely the tax brackets should start increasing as economic growth increases, and of course we're starting to see spending power for most Kenyans also on the upside.
Okay, I think the figures, the projected figures for the growth for this year are actually about 5%. Moved up from 4.5%, but it could be an indicator that maybe economic growth is not as strong as we expect. But there's also the other factor whereby Treasury was blamed the deficit on that withholding tax. They're not withholding the whole 100%. Most banks and contractors are withholding about 50%, and the other 50% comes from the taxpayer. So there's a bit of a lag in collection of all the funds.
Kenneth, let's touch on mortgage lending rates and the trends that we've seen over the past few months.
Actually, I think the central bank released a report late last week where mortgage lending has grown by over threefold in the last few years, which is actually a positive for the Kenyan economy. And look, we're also seeing mortgage lenders coming to the market to raise funds from the domestic market, the domestic bond market. Basically, one of the major limiting factors on mortgage lending in this country has been long-term finance. And with a stable fixed income market, we should be able to overcome this and hopefully mortgage lending rates would reduce, and we'll see a lot more people coming to the market to source for long-term financing.